Okay, good afternoon, everyone. I'm Doug Elliott from the Economic Studies program here at Brookings. Thank you for coming, despite the continued cold weather, which I at least am getting very sick of. So as you know, we're here this afternoon to talk about the role of collateral in the financial system, particularly in what is often called the plumbing of the system. And we're fortunate to have Manmohan Singh. He's one of the great experts in this area, and there's also a superb panel which will follow. He is a senior economist at the IMF here in Washington, and you have a copy of his detailed bio in your materials, so I won't go on at great length about him, though I was impressed to realize he's making absolutely no money off his new book, because apparently being at the IMF, the royalties have to go to the IMF Widows Fund, if I got the name right. Anyway, so we're going to start with Manmohan. He'll talk for about 25 minutes or so about some themes from his excellent new book, Collateral and Financial Plumbing. I must say the book is a great source of information on a topic that has received far too little attention. And for those who are interested, copies will be available for purchase outside the room afterwards. But apparently, and this is the first time I've done this at Brookings, we are going to do a drawing, and 3 of you will get free books, which, since it's actually slightly pricey, is not such a bad deal. So if you haven't, there is a bucket outside in which you can drop your business card. And basically at the end of this whole shindig, I will draw 3 of these. I wonder if I have anything up my sleeve at the moment. I should have thought of that. Anyway, so we'll start with Dr. Singh, and then after he speaks, I'll ask him a few follow-up questions, and then we'll give you a chance from the audience to quiz him. Following that Q&A period, we'll then leave the stage and have a panel of 3 people follow. Each of them will talk for about 10 minutes on a topic of their choice related to collateral and financial markets, which this is an expert enough crowd, I'm sure you all realize it's a very wide topic. So you're going to get 3 fairly different takes on things, which we thought would be a nice diversity of views. The 3 experts that we have are in the order they're going to speak. There's Sandy O'Connor, who is the Chief Regulatory Affairs Officer at J.P. Morgan. I keep forgetting to say Chase. I grew up in the old J.P. Morgan, so J.P. Morgan Chase will lead off, followed by Daryl Duffy, who will be appearing here long distance on our screen. And I can see him, but none of the rest of you can. He's there. He looks good. Okay, there he is. So you have a brief look at him. He'll come back later. And then we have Say Srinivasan, who is the chief economist of the Commodity Futures Trading Commission. Their full bios are also in your materials, so I won't take more time now to explain their illustrious careers. So with that, let us start off with the main event.
Thanks to Doug and to Brookings for this opportunity. I'll go straight into this because I have more slides and number of minutes here. This is a snapshot of the key messages which I have in my book. Basically, financial collateral. These are like US Treasuries, German bonds, which can move cross-border. The numbers associated with this collateral are huge and at par with money metrics. So when we learn about money, M0, M1, M2, these numbers are an integral part of financial lubrication, which involves either collateral, you can settle accounts with collateral or with money. And the numbers are large enough that we cannot be dismissive about them. That's a key point which I'll try to describe through data, that these are large volumes which you cannot ignore. And I'll apply it, at least today, to 2 themes. One is monetary policy, where, with the QE, central banks have interplayed or interfered with the financial plumbing. Markets used to do the plumbing. Now with QE, basically what that means is you take collateral from the market. In exchange, you print money and pass that to the market. So a huge amount of collaterals have been taken in by some central banks. So far, it has been the Fed, it has been the United Kingdom, and we'll see ECB doing something next month. And the second thing which I'll try to get my hands on today will be the proposed regulation of moving OTC derivatives to CCPs or central counterparties. There are other themes over here, which I'll just try to give you a flavor up front. I may not get into that. The shadow banking should not be a pejorative term. It's always viewed with a negative connotation. There is capital even within shadow banking. You know, when shadow banking actors move, there are margins, there are haircuts, and that's the capital. Unfortunately, nobody has compiled a study on what is the capital associated in the shadow banking world. We have Basel 8%, but we do not know what the corresponding number would be in the shadow banking world. However, my take from the book is it's not a pejorative term, it's not a negative, and chances are, given the way we are going to trim the banking sector, by default, shadow banking sector will grow. QE and regulations have overlapped in the changing collateral space. As we look forward, we cannot look at regulations independent of QE. There is an overlap, and I'll try to see how much I can get that. But please be cognizant, you cannot look at regulations without the flip side, which has been QE. And it's still happening. One central bank will start QE next month. Safe asset, is there really a shortage? And here I'll try to bring in the concept of the reuse of collateral, because there is 70 trillion plus of AAA, AA securities. Only a small fraction of that actually gets reused. A lot of it gets siloed, and it doesn't see the light of the day. Now, if you do want to make some country wants to be in the business of public good, there are many issues out here. Which country? Why? Isn't there a fiduciary duty from a debt management angle also as to what type of collateral should be coming out? So the safe asset side story has to be cognizant. There's something called the reuse rate, or what I call the collateral velocity. So let's jump into the first theme, the monetary policy side. If you look at the last Lehman annual report, 2007, November, December, the yellow ink here is basically cut-pasted from the annual report footnotes. As of November 30th, 2007, the fair value of securities that was received by Lehman that was permitted to be sold or repledged in Lehman's name was about 800 billion, of which about 725 was actually used by Lehman. 800 billion. The balance sheet size of Lehman, this annual report, was 700 billion. So clearly, a lot which shows up in footnotes of these balance sheets do not make it to the balance sheet. That's an important point. Yes, things are changing. Yes, Basel III rules will push a lot of off-balance sheet items on balance sheet. It will be difficult to keep things off balance sheet. There's leverage ratio, there's all sorts of other issues coming up where it will be difficult to be in a world where Lehman was, but this is a very large number, bigger than the balance sheet, and this number is not easily found in call reports. Most of the flow of fund is done on balance sheet data. So things beyond the balance sheet data doesn't get picked up. You know, a lot of studies we see, including from New York Fed, is on flow of funds. But this is where it comes in, and I will try to show you this is not isolated to Lehman. So look at these charts very carefully. It took a while to make these charts because you'd actually have to read the report. If you look at you actually have to read this, yes. If you look at the light blue columns, 800 billion for Lehman, right? As I said, bigger than the balance sheet size of Lehman. And if you add up all the light blue columns of the key banks, based on Lehman, Morgan, Goldman, this is a bit tricky, but you have to deal with the investor relation office to figure out what's going on between a Merrill and BOA. Largely it was Merrill Lynch, but now they combined. So to show continuity, I had to call them JP Morgan, Citibank, and it doesn't stop here. The Europeans are also pretty good at this game. Societe Generale, BNP, Deutsche Bank, Credit Suisse, UBS, Barclays, RBS, HSBC, Nomura. I looked at the top 13, 14 banks. Of course, there are some smaller ones, but if they were below 50 billion, I did not care. So I picked up roughly 90% of the market. If you add up all these light blue columns I talk about, off-balance sheet pledge collateral which can be used in the name of this bank, is 10 trillion. I've counted them a million times by now. That light blue number, if you add up, is 10 trillion. Now, if you look at the most recent number, the orange bar, which would be 2013 ending, because 2014 annual reports are still in the making. Deutsche Bank will not have it ready until the middle of April. The latest numbers, that's the orange bar, if you add them up, it's about 6 trillion. Actually 5.8 to 6 trillion. The numbers have not bounced back since the euphoria in 2007. So 10 trillion to 6 trillion is a margin call on collateral. Something went out here between 10 trillion and 6 trillion. And these numbers are not bouncing back from 6 trillion in the last 3 years. This is an important fact, which you don't find in balance sheet data. Okay. Now, where does this collateral come from? Where do the banks get this collateral? In order to keep in the spirit of one slide a minute, hedge funds. Hedge funds are the largest supplier of this pledge collateral because hedge funds need to get funded. Hedge funds take leverage. Hedge fund goes to banks, and hedge funds, in lieu of the collateral, will get leverage or say cash in advance. There are many ways, rehypothecation, etc. There's one quirk out here. In the US, it's very difficult to extract too much out of rehypothecation, which is through the prime broker, because you have strict rules under SEC's rule of 15.3 CA and Regulation T. You cannot go beyond 140% of a client's collateral. However, in UK, there's no such rules. So oftentimes, if somebody is seeking leverage and wants to have a mark-to-market price of leverage, you are better off in UK. So all the rulings so far, Basel III, etc., has not removed this sort of a gap. If you have an affinity towards higher leverage and you're willing to deal with a prime broker, UK may offer a softer platform or less constraints than the UK. Hedge funds also borrow from repo. Just to show raw numbers, this requires some arithmetic with the leverage in the hedge fund space. Hedge funds used to contribute about 1.7 trillion. The numbers went down because everything sort of collapsed, assets under management, leverage. Now they've been bouncing back up, and the numbers are back around 1.8, 1.9 trillion. This is raw collateral coming from hedge fund. There's another bucket, the non-hedge fund bucket, just to keep it simple, where you have the sovereign wealth funds, the central banks, the pension funds, the insurers. They also supply collateral. And one good data source is RMA, because they don't double count. There are other data vendors like data explorers. There's some double counting. But long and short is about 1.7 was also contributed by this non-hedge fund, okay? But they have not bounced back from the number about 1 trillion. So in the last 2-3 years, they're stuck at 1 trillion. There are many reasons over here. One of the main reasons is counterparty risk. We have seen since 2008, first you had the stress test on US banks, then you had the Europeans getting into a tailspin, etc., etc. But this bucket has shrunk significantly since about 1.7 trillion around the time of Lehman. So we have 10 trillion of collateral, which I showed you, those light blue columns, which came in 2007. The raw sources was 1.7 and 1.7. Okay? Now think about it. If the raw sources are about 3.4 or 3.3 trillion, and the total amount of pledged collateral available to the large bank is about 10 trillion, how do we explain this? Or to look at it more recently, you have about 6 trillion in recent years, and hedge funds have bounced back to 1.8 trillion. The other bucket is about 1. That's about 2.8. How do you get to about 6 trillion? This is where collateral gets reused. And this is important to understand because this defeats all the logic of flow of funds. This is cross-border. So if a hedge fund in Hong Kong has Indonesian bonds and wants leverage, it goes to UBS, its prime broker, and says, okay, you can have this portfolio of, say, a 500 million of Indonesian bonds. It gets leverage. UBS books it to UBS London. Now, there may be demand for these bonds, either as an outright sale or a repo. We say a Chilean pension fund in Santiago, which is dealing with Santander, which deals with, say, a Citibank London. And that's how the market connects itself. The bonds, this collateral gets reused. It's not idle. Somehow there's between these 10, 15 banks who have a global footprint, collateral moves across jurisdiction. This does not make it to the balance sheet. So in other words, you could have a hedge fund wanting leverage. It wants cash. It passes on collateral to Goldman. Goldman can use the same collateral to settle accounts with Credit Suisse. It has debit credits every day. Credit Suisse may pass on the collateral to a money market fund, which under its 2A7 may use that a collateral for 3 months, 6 months. That's how collateral gets connected. So when I talk about these numbers like 10 trillion, it is the reuse rate or the intentional double or triple counting in the system, which moves collateral from one point of supply to where it's demanded. And then it can move again after a 3-month, 6-month repo or whatever. But that's the logic and intuition of collateral reuse. Collateral, like money, like when you put $1 of deposit at Citibank, it finds a way to the guy who needs it more than the guy who's putting it there for savings at, say, 1%, and somebody else could make more than 1% off that dollar. Intuitively, what I've said so far in a summary, we have sources of collateral, we have the total amount. This is the lubrication, which is a very large number, and I'll just compare it to money metrics, that these numbers, in order for you to make 3.4 into 10, there's an intuition of a reuse rate. And the reuse rate has gone down from about 3 to 2. I'll come back to this. But this, some people call it collateral velocity, but the reuse of collateral is declining. And I'll link QE over here. When you take very good collateral, like US Treasuries and MBS, and it cannot move because it's at the Fed, and so far the changes from 2007, about 3 trillion of new collateral is on the asset side of the Fed. It doesn't rehypothecate, it doesn't get reused. It makes an impact in the market because in the market, to move a portfolio of security, those Indonesian bonds I talked about, the AAA or BB or single A collateral will move along with AAA. The portfolio should include some good collateral so you can move the bad collateral. Bad collateral doesn't move on its own. So when you take away the good pieces, it makes the whole collateral hard to move in the global financial system. So intuitively, and I think this is as sort of extreme I'll go in terms of being analytical, that gap between green line and the red line in the beginning, the 2007, that's the 10 trillion. That's between like 22 and 32 trillion. Intuitively, even if okay, so let me explain the lines. This is the US broad money, M2. The red line includes the US broad money plus the European broad money plus the UK broad money. Okay, and if you see some kings, it's because of QE. I've not included Japan because Japanese collateral is it stays within its borders. It's not cross-border. Now, if you throw in above the red line, if you throw in pledged collateral or those blue columns I showed you, that gap was 10 trillion between the top of the green line and the starting point of the red line. That gap is now 6 trillion. Remember I showed that market has collapsed? And there's a lot more money lubrication in the system relative to collateral lubrication. Intuitively, if this was 10 over 33, that's about 1/3 lubrication. Now you're down to 1/5 lubrication. Collateral being siloed, collateral being less reused in exchange of money, you find more monetary stimulus, more money lubrication relative to collateral lubrication. Okay, now this is something we all learned in economics about ISLM. You have real interest rates, you have output. LM is supposed to pick up money, nothing else but money. And on IS, we capture things like C plus I plus D, consumption, investment, and government. Somewhere over here, I was never taught, where's the 10 trillion? Is it part of money, LM? Part of IS? I don't know. But we had internal discussions. I was in the research department, and he said, no, LM is strictly money. That's the monetary side. So intuitively, you can use collateral as an investment good, which gets reused, and you can show the same analytics as if it was part of IS. So if there was a significant move in a collapse of collateral around Lehman's time from 10 trillion to 6 trillion, you can show the dynamics we are seeing, which we see today about the negative interest rate, how the output has changes, and this shift of LM is intuition with the money metric. So you have a collapse in lubrication, which you're compensating through money. You cannot get it, but this was never taught, and I still think in many textbooks, we don't have a room to show lubrication outside of money. That's the only part I want to bring over here. Now, I'm applying it to monetary policy. You see, good collateral and the monetary policy was almost exactly the same before Lehman. And you can pick it up through the Fed funds rate, which is the US monetary policy rate, and the GC rate, which would be in normal times, that would pick up what's happening in the repo market in normal times. And we had a monetary policy rate which was in sync with the GC repo rate. If it was not with the collateral rate, the SOMA desk at New York Fed would make sure it is not more than plus minus 3 basis points of the GC rate. So basically saying is that an overnight credit, whether secured or unsecured, of a country like US, the AAA, was in sync. So the collateral lubrication type or the money part was in sync. Things have changed a lot since those days. Now we do not have the repo market in sync with the money markets. There's a lot going on since 2008 October. We have had banks have 25 bips, which is the green line, called interest on excessive reserves. I did not show the Fed funds rate now. You say why? I did not show it because Fed funds rate is, in many ways, people say is broken. It's nothing else but the rate at which non-banks cash, Fannie, Freddie, large hedge funds, BlackRock, who have extra cash, who don't have access to this, because this is only for banks, only for depository institutions. If you don't have access to this, you can go to a JP Morgan, you can go to a Citi and say, let's negotiate, maybe 10 bips, 12 bips, and I'll get 10 and you get 15. That's how they get a dip in the IOER. Now, so I don't show the Fed funds rate, but it's basically around 10, 12 basis points. That's the split between a bank and a non-bank on how to invest the cash. There are many issues over here regarding large banks having to pay FDIC, levy, etc. But the long and short is Fed funds rate doesn't have much economic content. We have a few interesting things. This is the repo rate. It's not in sync with the Fed funds rate. This will be very interesting as we lift off. It's not in sync. As I said, Fed funds rate is stuck at 10, 12, and largely a lot of the foreign banks are in this game because foreign banks don't pay FDIC levy. Svenska Handelsbanken, if you look at the balance sheet, a lot of this money is made to the Fed arbitrage by the Swedish bank. Now we have come up with something called the reverse repo program. The reverse repo program started off with a floor of 3 bips, moved to 5 bips. Around the quarterly ending, there's more demand, so they have even raised it to 10 basis points. This provides a floor to the repo rate. I think it's the flip side of, since the US monetary policy could not go below zero, it made a choice, maybe because of the par NAV of the money market funds. Reverse repo also made sure that the repo rate could not go below zero. Because in intraday trading, it shows signs of going below zero. So this is the floor, and chances are this will be a very important tool as Fed wants to get the Fed funds rate somewhere up. So when you talk about a lift off, these rates will be very important. Remember, when we lift off, we don't have the Fed funds policy rate or whatever the policy rate is to be very different than the purple line. Repo markets, the price of collateral, the money markets where the Fed funds rate should be in sync in normal markets. You cannot have lift off with a wedge over here. Just to show those who are not from here, the Europeans did not think of zero as a magic lower bound. They went below zero. Right now, the deposit rates at ECB are minus 20. Their Fed funds rate is called EONIA. That's gone below zero. And its repo rates, if you look at the German Bunds repo or the French, also goes below zero. For them, there's nothing magic about zero. However, in the US, we have had some peculiar movements north of zero because of our, I'm a US citizen, because of our hard constraint at zero. Okay, now, what's the practical implication of all this? Where's my 10 trillion? Where's this? With QE, look at the change in deposits. The top 4 banks, Wells Fargo, Citi, Bank of America, JP, now have almost 4 trillion as deposits. Net change of 3 trillion in deposits at the top 50 holding companies. There was a very nice paper by Carpenter et al. 2003 where they showed that most of the QE was done by non-banks selling to the Fed, not banks. The dealer inventory remained roughly the same. So non-banks, sovereign wealth fund, pension fund, insurers, whoever, hedge funds, they sold to the Fed, not the banks. It's very important. So when non-banks get this cash, 3 trillion worth of cash, what do? They have to put it in a bank. When they put this cash in the bank, it takes away bank balance sheet space. And if you talk to any bank regulator or anybody on the risk side of banks, they'll tell you what the bank balance sheet space has done. There's something called excess reserves. The reserves you don't need to put with the Fed. That's just required reserves. Excess reserves are so large now that for banks which had pretty much the number at zero, excess reserves, now about a quarter of the balance sheet, reserves to total asset is reserves. And many large banks will admit that as the leverage ratio comes in, this bank balance sheet space is getting scarcer and scarcer for us to do other activities. They would like the reserves to be off. The reserves are okay, or this, because you are getting 25 bips in a zero rate environment. As the yield curve goes up in normal times, you will not want a balance sheet cluttered with deposits. So QE has taken away bank balance sheet space, and this remains to be seen how it's addressed. There was recently a meeting in London where they may be soft on the leverage ratio, which might allow some movement of this bank balance sheet space in exchange for not using clients' collateral in the OTC market, but that's getting very technical. The bottom line is bank balance sheet space of some of the top banks have been taken away by these deposits due to QE. This was, if you look at the blue area out here, that's the plumbing. That's how markets would take collateral and money would be exchanged. This is before central banks did QE. If you just focus on, there's money coming, the short-term money, there's long-term money which comes from this side and the hedge fund side, and the dealer banks would move it in a way where, the money market fund would get collateralized funding, so they would get a better name like JP Morgan than, say, a small hedge fund. That's how the bilateral repo market worked. Now, I want to make a point which is clear. The bilateral repo market, for which we still don't have very good data, we still don't, there are estimates, is a market for collateral. It's a genuine market for collateral between those blue boxes. The tri-party repo market is a market for funding. Collateral which overnight you can get funding based on that inventory which did not get used in the bilateral repo market. It's a point I want to make because many people extrapolate one to the other. This is what's happening with the new Fed's reverse repo program. If you see the green area is taking away the blue boxes. That's the plumbing going on in the blue boxes. No interference from central banking. But when central bank comes in and takes away collateral, de facto it has interfered and will interfere as the collateral unwinds over time, 5-10 years. Until then, the reverse repo program, the greening of the blue boxes is showing that the plumbing is being affected. In a sense, if you have this reverse repo program allowed to everybody, including hedge funds, there will be no plumbing. There is a rusting of plumbing happening with the RRP, and Fed is very accurate in keeping this lid on this rusting because the RRP is capped at 300 billion. Recently, they added another 300 billion for the term RRP. But the bottom line is, from the shadow banking literature, one would construe this to be a put. You're giving guarantee, collateralized funding to money market fund and the Fannie Freddies because you didn't need to. The bilateral plumbing never broke down. Bilateral plumbing always worked. We just don't have a good handle on the data, the size, etc., the rates, the haircuts, but it worked. This RRP is necessary for other issues, monetary policy issues, but if you make it asymptotically available to everybody, then you break down a plumbing, bilateral plumbing, which works, has always worked and still works. And you increase the put. The word put is for giving guarantees to money market fund, etc. That's another way of saying that. Now, people talk about the reverse repo program. It's getting technical, but basically, if non-banks use the reverse repo program, like I showed over here, the money market fund, the GSEs, some of the AAA like BlackRock accounts which are 2A7 and they are eligible, that collateral at the Fed doesn't come out to the market. There's a difference between ownership and possession of collateral. Basically, it's a change in name in the Fed balance sheet. Excess reserves, so a non-bank money market fund will go to JP Morgan, take 100 billion, call an RRP with the Fed. Takes the deposit, JP Morgan's happy because it gets bank balance sheet space, but it's just an accounting change in the line item of the Fed. From excess reserves will drop down and RRP. That collateral cannot be rehypothecated. It doesn't move into the system. If it's done with the banks are eligible. Banks have no incentive because they can get 25 bips, so why will they bid for 10 bips? But assuming there's term RRP and assuming there's revenue from rehypothecation, it's very difficult. But if we see the light that the term RRP gets very long, that rehypothecation of collateral is only within the tri-party, which is also not going truly into the market domain. So what I'm saying is there's about 3 trillion, roughly 3 trillion change from QE, which has gone to the asset side of the Fed balance sheet. And that collateral used to interface with the full financial system, banks and non-banks. Now, the reserves which have been created is mostly with the banking domain. In other words, this is from Mr. Dudley's speech, I'll come back to this. What I want to show here is, in this world, which is the mapping of a financial system where short-term money come in, long-term monies come in, the dealer banks, and then there are borrowers who are banks and non-banks. In this world, you have collateral moving full through the system, and now the reserves which are created as a lubricant are of lesser quality than collateral in the market domain. I'll switch gears, but I want to go back to a quote from President Dudley of New York Fed. Just read this sentence. Also, with an exceptionally large balance sheet, there will be considerable attention on the methods that the FOMC will use in order to exert control over the level of short-term rates. We go back to a very timely topic about the lift off. And what I'm showing over here is, and I'm tying what I've said in the last 10, 15 slides, from an overall lubrication perspective, the financial system, money plus collateral. If collateral velocity has already reduced from 3 to 2, there may be less tightening needed. You've already held this collateral, which was a lubricant, less of a lubricant. So when we go out into the new world, and this is again from President Dudley's speech, this green line is what we see today, but had we not changed the balance sheet and buying and associated QE, we would see the blue line. There's a gap of about 200 basis points. Typically, when you go from a recession to a peak, there has been a 400 basis point tightening in the last. We may not have to tighten so much because we are at a much lower position. It's been sort of hidden because of the changes in rates bound at zero and the composition of balance sheet. If I go back to this, there has been tightening done on one part of lubrication, collateral. So on the money part, we may not go back 400 basis points above zero. The new normal called 200 basis points, simply because of, unless the balance sheet changes, and I don't see that happening anytime soon. I'm going to switch gears at 4 minutes, and I'm going to talk about this other theme, OTC derivatives. This is what's going on. There is some risk in the large banks. These are some of the key CCPs. ICE, LCH, ICE Clear in UK is changed name, and CME, and there's one more coming up in Germany called Eurex. Basically, there was a risk where large banks had something called residual liabilities. We could have addressed that, but we didn't. So we shift the full spectrum of OTC derivatives into the large CCPs. And I'll talk about the 4 or 5 of them because clearly they're too big to fail. This is a manifestation of overnight asking in the Pittsburgh 2009 summit to move OTC derivatives. It's a slow process. It's a difficult process. I think some people after me will be speak to this, but this in a sense is what's going on in the OTC. Standard contracts, not everything. And contracts which are easier and standard can move to this market. There have been rough estimates that maybe 1/3 to 40% of the market cannot be cleared by definition. This is the amount of under collateralization. These are BIS data. That's the only comprehensive data which shows numbers. What is the under collateralization in this market? This is after netting, all the benefits of netting. Between 3 and 5 trillion, 3 trillion and 5 trillion worth of under collateralization. So somebody is piggybacking the system relatively free. Somebody is not posting his or her share of initial margin or variation margin. Point over here is even the most latest number, 2014, was about 3 trillion, 2.9. The point I'm making is this number has to be covered. If this regulation is worth its salt, this number has to be covered. Now, ISDA will say there's about 3.8 trillion of collateral. And then they'll say in the annex, well, that's about half of it because we double counted reverse repos and repo. So if ISDA is saying there's about 2 trillion, that collateral is after being reused. Even if you take a low number like 2 or 3 for collateral reuse, in effect, the amount of collateral in the system is not more than 1 trillion. Today, we have still up to reach 3 trillion. That gap of 2 trillion has to come from somewhere. A lot of these regulations now have to understand how to find that collateral, which is needed for bank capital, leverage ratio. You have all sorts of constraints on the banking side, and then a serious amount from the OTC derivative side. And it makes it too expensive even to cover this. But it remains to be seen how we reach the under collateralization, given that the amount in the system today is not more than 1 trillion. There's one last thing, because this is my last, try to talk about something called VMGH, variation margin gains.
It's your last.
This is my
It's your last.
So there is a proposal which is now, at least in the regulatory circle, and you'll find a handout from JP Morgan outside and CME. What happens if a non-bank gets into trouble? If indeed we have done a good job in shrinking the banks with all this leverage ratio and holding them responsible and off-balance sheet constraint, if we push the risk to non-banks, and some of them are giving the SIFI stamp now, we'll see what that means. But CCP is one of the non-banks which sort of interest me a lot. We have proposals which are bail-in proposals, like this one, where, to make a long story short, the system can take care of any risk to a CCP. You just take more haircuts. there's a lot written on this. And there's a recent study from Reserve Bank of Australia, which analytically shows that the contagion from such haircuts will not be extensive. It will be minimal. Very clean study. I've not seen any other study which is like this. So if you have clean bail-in proposal and yet people don't embrace the proposals, then it is very likely that although we may contain banks with all these plethora of regulations, we may end up bailing a non-bank like a CCP. Thank you.
It would be easy to look at all this that you've shown us, say this seems incredibly technical. You've more or less said almost nobody understands it yet. We need to know more. Do we want to be doing this stuff? I mean, what is the economic and social advantage of having this way of doing what you call lubrication?
Well, for some real reasons, if we do not get a grasp of what is outside the flow of funds metric, which is used extensively, most of the studies don't go below flow of fund, we'll never get a handle on this non-bank bank nexus. And banks are small in terms of capital, say 13 trillion around Lehman's time. However, their footprint, the way the system goes through the banking system is immense. So to focus, and we have focused correctly at equity and leverage of banks, but increasingly, I think Basel, FSB, etc., are correctly trying to understand the bank, non-bank nexus. Look at the number of working groups from shadow banking to OTC derivatives to the resolution of a CCP. There's at least 6 to 10 working groups trying to better understand the full picture rather than beefing up equity at banks or reducing the leverage of banks. So I think somewhere at the G20 level, they have been cognizant that we need to go beyond what lens we used to look at things. And I think this is just trying to show that that lens is bigger and it...
I can certainly see that point. My point was a little bit different. In your book, at least implicitly, part of your argument is that shadow banks is too pejorative a term. Perhaps collateralization is viewed as bringing more risks than benefits, and perhaps that's not considering the benefits appropriately. That there's maybe been too big a shrinkage in this area. I may be reading too much into that. But if part of what I'm saying is your correct view, what is your counter argument when somebody says, nobody understands this crap, why should we let people do it?
Because our understanding is myopic right now.
Mm-hmm.
Unless we expand it and acknowledge that there are some real issues in the plumbing, monetary policy, the regulations will remain not correct in my view. For example, we are looking at the Fed's policy rate, okay? And I mentioned the policy rate, Fed's policy rate, the policy rate of the world, doesn't have complete economic meaning. Now, there are reasons why we didn't go below zero and why the Europeans went below zero, but there are some fundamental issues out here I'm trying to bring out which will be addressed over time. It may take 2, 3, 5 years, but if we don't get the financial landscape, for example, I talked about the bank balance sheet space, we may be chasing the bank, we may be shrinking them, and 5 years down the road, we sort of start bailing out a CCP. This is not very difficult to see, given the way the numbers are sort of lining up today.
Okay, now you've made a good and strong point about collateral velocity and how a decrease in collateral velocity is equivalent to a tightening that has occurred, and therefore there might not need to be as much conventional tightening, possibly. What is your view as to what will happen going forward to collateral velocity? Can we tell at this point whether that will go up or down?
Collateral is scarce. number one. We can see that from as far as Reserve Bank of Australia's issues, including Fed's RRP, that they are addressing this issue. They're also fine-tuning the regulations. If you look at the timetable, it's being postponed, deferred, some concessions made. However, I feel collateral velocity will not bounce back. We have a large central bank in Europe who will start QE next month. Fed is unlikely, as I tried to explain, to let go the collateral very quickly. Whenever the policy rate will move, you will release collateral so that the repo rate and collateral and the policy rate are in sync. I do not see collateral velocity coming back. If we accept that premise, we do understand that perhaps there has been some tightening. And it is very likely that this tightening cycle, and not trying to muddle with the strength of the dollar, etc., that this tightening cycle may not be the level of tightening we have seen in the last 3 cycles. So if this arithmetic and this logic has some bearing, we may see a policy rate which is not at the usual 3.84%, but more at 2% because we are starting from a negative number. And that is why I showed the chart from Mr. Dudley's speech that the blue line is the line which would have been more true had we not done this balance sheet movements.
Okay, now let me give the audience a chance. And Mohan will be coming back during the second Q&A period with the panel as well. So this is not your only chance, which is good because we don't have a lot of minutes with him. So let me just lay out the ground rules. Please wait for the microphone. Identify yourself by name and affiliation if you have an affiliation. Remember that a question is actually a question, something that he can then answer. And that should probably do it. So, ready? Sure.
Thank you. Neil Rowland with MLEX News. I'm just a simple journalist, so please forgive the rudimentariness of this question. Is there a problem here? Are there policy implications to what you're saying?
I would say problems. I would say it gives some more light to this whole regulatory debate, monetary policy, and the many issues which I talk about. I just chose 2 over here. It's just trying to give you another angle which have been missed so far. So no, there's not a problem, but I think it augments the work being done, number one. And number 2, what was the second part about? I have tried to show that, for example, monetary policy may be cognizant that there has been tightening done. From the OTC derivative space, if you see what I've shown, people are cutting corners. They go to ETS, etc., because the collateral demands for using derivatives may change. If everybody has to pitch an initial margin, variation margin, they may look at other avenues. And we have seen the regulators flag some other areas where you may be cutting corners on this collateral. If collateral gets expensive and you really need to pitch in collateral for OTC derivatives, they'll go to a place where you can cut that corner. So yes, this does tell you areas which people might skirt because collateral is required for certain products.
If I could follow on that excellent question, is it fair to paraphrase what you've just been saying as you think it's really important to understand these aspects? Understanding it may lead you to somewhat different policy decisions, but it's not that you think there's a massive problem. It's that you think a better understanding will lead to better technical answers.
Absolutely, absolutely. I think the problem was with banks. They focus on the banks. This system is wide and went beyond the usual flow of fund analysis. As we understand the system, we can see the working groups in progress. They take time. You have a lot of countries agree on certain issues, but these are on the table. They just, I think it's important that they're on the table, and and I think they will lead to some results in the near future that the bank non-bank relationships will be addressed. It's just showing that these numbers are not trivial, and they should be incorporated somewhere.
Martin?
I'm Martin Bailey. I'm here at Brookings. I can't claim to be a simple journalist, but I still am struggling to understand some of. I'm a simple think tanker, and it's a little bit of follow-up to the previous question. So we brought interest rates down as far as we could. Obviously, we can't go negative. So that's perhaps been one reason why the recovery has been more sluggish. Other people have pointed to maybe regulatory changes which have gone with increased risk aversion, made lending more difficult. So my question is, Is this lack of collateral limiting lending in some way? How is it affecting the real economy? Who's it affecting? Is it affecting household lending, small business lending? Where's it showing up? How is it creating more tightening than you would otherwise imagine were there?
That's a difficult question to answer, but let me give it a shot. If you believe if Fed tightens from 4% to 1% is tightening, this is no different than that, except that the examples are new. So for example, if say you could have IBM issue a bond, okay, which could be bought by pension fund insurers, etc. And for some reason, the collateral market doesn't allow the pension fund or the hedge fund to sort of make augmented returns or to move the collateral, chances are that that IBM bond, which IBM will issue, will be at a higher price than had the collateral market been functioning more efficiently. Long and short is it makes an impact in borrowing cost because collateralized lending is less because there's less collateral in the system. So on the margin, yes, real sector household will be impacted the same way, except that we are very used to the monetary side of lubrication. In reality, besides M0, M1, M2, you also have some C0, C1, C2, which we have not documented. That's the intuition behind your question, which is hard to describe because you don't see real sector numbers. Most of the data is associated with monetary policy M0, M1, M2. In fact, the Fed doesn't produce M3 numbers since 2005. And that M3 world is what I'm trying to entangle as far as I can.
And if I catch the implication, it sounds like part of what you're saying is the distributional consequences of a tightening through interest rates is similar to the distributional consequences of a tightening through collateral.
Yes.
Okay.
Now, I just want to put a little caveat that the distributional tightening through monetary metrics seems to be broader because that sort of encompasses everyone. Mm-hmm. When you have QE and collateral tightening and a smaller spectrum of players like non-bank pockets, etc., the distribution is initially, the first round is towards a smaller circle, then the bigger circle, because it's a much more sophisticated.
Okay, fair enough. There.
Daryl Duffy at Reuters. I'm also a simple journalist. You've talked about monetary policy a lot, but are there any consequences for financial stability where perhaps regulators may look at this market and not perceive a problem that's actually looming?
We have to be very careful with journalists. So for journalists, please, if you do quote, I don't mind double checking. No, I don't see problems because I think they are all very cognizant of these issues. We have ways to engage with them. They are just trying to formalize this in the various umbrellas. You know, FSB is an umbrella organization, BIS has working groups. So no, they are very much alert. In fact, I do cite some of them in the beginning of my book, like Professor Shin, he is now the head of research. So no, they are not oblivious. They very much know this, but it takes time to formalize and pick and choose what's more important on the regulatory agenda.
On the aisle there. And then, sir, just so you know, all the way at the back, there's been a very patient guy.
Very quick. Charlie Thomas from the Federal Reserve Board. So in your diagram, it was very nice. It had the funds starting on the right and going through several people to the ultimate borrower on the left, and the collateral moving to the right through. My question is similar to the first one. What difference does it make if you have the three guys in the middle who are just passing the funds through them while watching the collateral go the other direction? Unlike in banks, where we think they're actually doing something, checking credit, that sort of thing, it's not clear in this part of the system that those guys in the middle are actually doing anything. And so why would I care if they disappear and your velocity goes down?
This goes back to what I made a remark on shadow banking, that there is capital within this type of movement from, say, the hedge fund to ultimately the money market fund. The money market fund now is getting a better credit. So when you talk about there are credit checks in the banking literature, similarly, the money market fund is now getting a better credit of Credit Suisse in this particular example. And there are haircuts between the movement from the hedge fund, whose collateral or portfolio of securities is checked at the Goldman Sachs level, and then there may be less checking between dealers, but also between Credit Suisse and the money market fund. So I would not put it very differently than the banking system. The sad part is the level of haircuts and the way the collateral moves within this non-bank bank nexus. We don't know the extent of capital. My understanding, my intuition would tell me it's less than 8%, what's at Basel. Hence, people prefer to do activities under the shadow and expect to get a put down the road. But there is level of haircuts and margins which may not be commensurate with 8%, but I've never seen any calculation about what is the level of capital which is going from point A to point B. Now, the other angle I want to say is this volume of 10 trillion, which sort of comes up between the demand and supply, it has to factor somewhere on this ISLM mapping. Because if you have concepts of base money and M2, you similarly need to put that 10 trillion somewhere. It's not a small number to say, well, what difference does it make if you take out the dealers and you have, let's say, you collapse everything down by 1/3. I think it's the same intuition you have if you say my deposit goes to Citi, goes somewhere else to an ultimate user. And that 10 trillion is what really sort of got me moving. It was the M2 for US around Lehman was 7.5 trillion. And the numbers over here between the 10, 15 banks was 10 trillion. I could not ignore it.
Is that all the way in the back? Yep.
Thank you. Hi, my name is Jay Savage. I'm an economist. I'm from UMCP. My question for you was just if you could address the question of flight to quality flows, particularly the issue with procyclicality and with the uncertainty that comes with the economic uncertainties and how that affects the variations in the amount of clearing that's required in margin?
I think there are three questions over here. I don't think I can comment on flight to quality if this is related to some of the issues we are seeing in the news today.
Okay.
Coming back to procyclicality, I think the proposals from Basel, etc., on procyclicality, there is always some room to maneuver. There's always some room to maneuver by central banks on the haircut level. However, procyclicality or margin haircuts associated with global repo market agreement or global sec lending market agreement, I think you will agree with even heads of the BI's markets committee that won't be impacted because that's bilateral. So GMRA, GSLA, I don't think will be impacted, and I actually agree with that. There's certain bilateral plumbing which is done, and I don't think official sector would want to go there. So this pro-cyclicality literature is not very clear, but to the best of my knowledge, I doubt if it will be able to permeate a bilateral contract. Your last question is about collateral and clearing. Yes, there is a large amount to be cleared. As I said, there's a clearing angle and non-cleared. Banks will still keep non-cleared OTC derivatives. And that has not been discussed too much. We have a panel after this, and I think somebody will address the issue of uncleared OTC derivatives. On the cleared side, whether it's half the market or 2/3 of the market, you cannot shortchange that. IM and VM will be posted. But what's uncleared is the residual risk, which will still be with the banks. What's the size of the market? Is that a real risk? Will there be netting or destruction of netting? I think the panel might be able to address that better.
Well, that sounds like a good segue. We're running a little over anyway, so let's move to the panel. So we'll start with Sandy O'Connor.
Doesn't seem, can you hear me? Yeah? All right, we're all good. Well, thank you, first of all, Doug and Brookings for inviting me to speak here today, and Manmohan for what you've just walked us through, a little bit of some crazy spaghetti charts, but that's sort of what the world is that we live in, right? Definitely want to take a couple minutes here. I know, just to reference some of your remarks, you talked a little bit about quantitative easing and slowing down the velocity of collateral and RRPs opening up the system. I would add to that, Beyond those two factors, clearly the Basel III regulation on the regulated financial sector has had an impact because when you think about the requirements under high-quality liquid assets for LCR and NSFR, that requires cash or liquid securities to be held on balance sheet to support the systemic risks that financial organizations can bring to bear. And if that is sitting in inventory and not going through the collateral velocity, which is exactly what's happening, that is also a contributor to the reduction in collateral velocity. And in answer a little bit to the question of why is it valuable to lend against collateral? I think you should consider it as, when thinking about the universe of lending on an unsecured basis, so lending your cash to a counterparty, that is of a higher risk order. You need to understand your counterparty. You need to fully understand what they will be using to deploy that cash against. When you are lending on a collateralized basis, the collateral becomes front and center. Will you get your money back? And if you don't, do you own that collateral? And what level of cash can you get back out of it? So the reality is you probably expand the universe of counterparties that can participate in financial markets and counterparties who can contribute to economic growth through collateralized lending. So those are sort of the way you might want to think about that. And by the way, velocity of collateral coming down is not necessarily a bad thing because there's less risk in the system. And that's probably appropriate given what we saw in the 2008 financial crisis. But now back to the topic that I'm supposed to cover. So CCP, central counterparty clearing and collateral. Firstly, as a product of new regulation, Manmohan mentioned that standardized derivatives need to be cleared centrally. That is now a regulatory fiat. Means there's a lot of growth and activity that's occurring across CCPs, and I think the most recent CFTC report in January said that 64% of interest rate swaps are now centrally cleared. So we're talking a lot of activity going through, and they're becoming centers of concentrated risk. Now CCPs on the positive clearly are reducing systemic risk because they bring together loss mutualization of tail risks. They also create some transparency. But what I'll get to in my remarks a little bit later, there's some unfinished business here because we haven't closed down what could be the beginning of building systemic risk, and we can close it down, and regulators and policymakers around the world are thinking about that. But back to the fundamentals of collateral. If collateral is going to be used as a building block for financial infrastructure and financial stability, it needs to have really important characteristics that we haven't really spoken about. One, not all collateral is created equal. Important for everybody to remember. While all collateral is good, it's not all equal. Two, having the right amount that you might need under stress really, really matters. And if it all goes wrong, regardless of whether or not you have collateral, you better have a backup plan, particularly when we're talking about systemically important CCPs, and that's some of the discussion to have here. So what are the right characteristics of collateral? Firstly, you have to be able to liquefy it, turn it into cash under all circumstances. Not just the nice fair weather economies that we deal in, but also when we're dealing under duress, in stress. And if this collateral is being used to underpin financial stability, like it will do in CCPs, it better have those characteristics, and it's really, really important. It needs to have reasonably transparent pricing and availability of pricing and reliable market depth, again, through whatever cycle we're talking about. Also important is that it carries the appropriate haircuts, because when you're going through economic stress, you have a change and fluctuation in pricing. And if you're going to go back to that collateral to make you whole, you really need to make sure you have enough of it, that you don't end up with a gap. And that's really what haircutting should be about. And back to the points about velocity is, it better be readily available. If I need to take possession of it, can I get my hands on it, or has it been rehypothecated away? And I think an important point to note here, not all collateral is allowed to be rehypothecated. And certainly it depends on what you're using it for. So don't think of all collateral running through the system and being rehypothecated and you don't know where it is. There are quite a few restrictions around that as is appropriate. But if you're going to rely on it for a liquidity risk management, you better be able to get your hands on it and know where it is and that you actually own it. For CCPs, a couple things to note here. Again, all those characteristics of collateral, super important, particularly when it's being pledged in support of initial margin or guarantee funds, which are the key components that enable the CCPs to function as core infrastructure, for standardized derivatives clearing. A couple things here. One, really important to note, as we see the evolution of CCPs becoming more systemic, governance around the types of collateral that should be eligible, what's accepted, the margin it's at, probably needs to undergo a more consistent approach to governance. What do I mean by that? Right now, the CCP management teams determine what's acceptable collateral, determine what the margin that's appropriate, and the clearing members, who ultimately could become the owners of that collateral under duress, don't necessarily engage in determining the risk appetite for that collateral. So over time, I think it will be really important for policymakers to consider, and clearing members and CCPs collectively, to ensure that, in fact, we agree on what's the right collateral that can add liquidity under duress if there's a stress in the marketplace. Similarly, there might be a place for a prudential approach to what are the minimum haircuts and the minimum eligibility criteria that should be required. Because again, CCPs and its functioning will be paramount because they are now systemic by regulatory fiat. And what does that mean? Ultimately, as more activity goes through them, if there is a bump or if there is a market stress, the approach can't be switch off and liquidate. Think about the massive amounts of collateral we would be talking about. Therefore, critical operations will need to stay open. And to keep critical operations open, you need to be able to have good collateral that may or may not be used to relubricate the system, but you certainly will need some ability to recapitalize those CCPs. So what can I tell you a little bit more about the CCPs? Really important, besides, as I said, having the right collateral, having enough. Having enough of it really matters again on CCPs. What do I mean there? Okay. CCPs currently undergo a good amount of stress testing, and that stress testing is used to determine how to cover one or cover two clearing member defaults, because you want to make sure you have enough resources to hand so that if something goes wrong and a default member, a clearing member defaults, you're able to take control of that liquidity, liquidate it, and allow the CCP to continue in an appropriate operating manner. Now, stress testing is good, but guess what? Right now, it's not standardized. It's not overseen by, sort of a prudential overseer. And in fact, while the resources currently allocated for initial margin and default funds may be adequate, the transparency is not yet there. And for the clearing members, it will be really, really important that they can validate that there are sufficient resources. It's super important here that not only do you get the number right, but also that all of the requirements are pre-funded. And I will say that here because right now, while there are recovery plans in place, should there not be enough resources if a clearing member defaults, the reality is a good portion of those recovery plans rely on assessment authority. An assessment authority means you call up the clearing members who provide support for the CCP through liquidity and securities, and you ask them for more money. During systemic stress, that probably is not the most important thing that we should be relying on. We should be trying to get the right numbers up front and get them fully funded up front. And what I will leave you with, since I know I'm at sort of the last little bit of time, is that recovery planning is absolutely essential. But items like, tear-ups and initial margin haircutting are probably not the best solutions, particularly if you think about tear-ups. A tear-up means there aren't enough resources, so let's pretend the trade didn't happen. You can end up with unexpected risks, unexpected positions, and items that end up with an open hedge. The reality is when you're at the tear-up point, you've hit the point of non-viability of a CCP. And in fact, rather than prolonging that CCP in its existing framework, you probably should have a resolution plan, which means you really keep that CCP open for business. All of their critical operations stay in production. Why? Because you can't afford for the pipes to come to a screeching halt. But ownership changes, recap resources which have been anteed up likely by a combination of clearing members will then ultimately become the new owners, and you'll move again from to a more mutualized risk model and a mutualized ownership model. But again, if I could leave you with a few things, the collateral matters. If it's supporting financial infrastructure, it better be liquid through all markets. You need to make sure you have absolutely enough of it. If you don't have enough of it, you have to make sure there are a couple recovery plans that could work, like VMGH, as Manmohan mentioned, could work to some extent. I'm not as enthusiastic about it in the bigger picture because I don't think it should be without limit. Because again, you don't then know what you end up with. And when you hit the point of viability, you should have a backup plan like any systemically important organization, and you probably need to do it through recap, because liquidating a CCP is not going to be appropriate because it is a permanent fixture in the infrastructure of the global economy. So with that, I will leave you.
We'll have Daryl next as soon as they do the magic.
Douglas, I just unmuted. Can you hear me?
Yes. Yes, we can.
Terrific. How about video? Are you looking at me?
We've got everything.
Fantastic. Okay, thanks for inviting me to do this, Doug. And thanks to Sai and Sandy, Manmohan. It's great to be here. I want to talk about some of the same issues, but from a slightly different angle. I'm going to focus especially on how to economize on the amount of collateral that we need to do a certain amount of financial services. So as we've discussed, by the way, could you advance to the framing the issue slide on my slide deck? As we go through this, I want to discuss not just the trade-offs between adding collateral to make the system safer and the costs associated with that. I want to also talk about cases in which we don't have to have a trade-off. We can do the same or nearly the same amount of financial services, meaning risk transfer and wholesale capital markets, with significantly less use of collateral. That's going to be the core discussion. But there's no doubt, as the others have emphasized, that the more collateral we use, the safer our counterparties. That's good, financial stability. And generally speaking, the more that we use, there are costs. There are two kinds of costs. I want to make a distinction. One of those kinds of costs is basically, has been emphasized by Manmohan in particular, which is slowing down the circulation of financial assets that you might want to have access to. So things like treasuries, if they're tied up in a certain place in a segregated collateral pool, then they're less available to serve the needs of investors generally, and that has a cost. The other kind of cost is not really a deadweight loss to the system. It's a transfer from, it turns out empirically, the dealers are mainly bearing the cost in terms of their shareholders, providing more effective capital buffer or liquidity buffer to their creditors, so amounts to a transfer. I'm going to come back to that. So all of these new regulations, Dodd-Frank and MiFID, in the case of derivatives and capital regulations, have been, generally speaking, increasing collateral demands, although the capital regulations are causing the dealers to try to economize on the use of collateral because that often reduces their regulatory capital requirements, which is what they're anxious to do. And what we're seeing right now is a very significant shift by the dealers, the dealer community, to economize on the use of collateral by doing things like trade compression. Just to give you an example, one firm, TriOptima, has now effectively eliminated about $200 trillion of notional positions in the interest rate swap market. I'll come back to that. simply by eliminating unnecessary circles of exposures. Another method that's being used is central clearing. Now, we've all been brought to believe that central clearing actually increases the amount of collateral in the system. Well, that's true because central clearing parties require initial margin from all participants. But under new regulation, dealers in particular would be required to provide initial margin anyway. And I'll show you that central clearing actually reduces collateral needs once you assume that the dealers are going to have to put up initial margin for all of their positions anyway. Something new that you haven't seen yet, probably, but is coming over the horizon, is central clearing of repurchase agreements and also central clearing of securities lending. And that is likely to economize on the amount of these securities that are tied up in one place or another by shortening those chains of transactions that Manmohan spoke about, so that we can do more, we can provide more services with those securities at lower velocity without really impairing the usefulness of those securities to the system. If you go to the next slide, I have a table of numbers that shows a rough estimate from the dealers themselves of how much it's costing them to collateralize their swaps. I'm not going to go into technical details, but if you scan the table for the top dealers, Goldman hasn't disclosed, but the other major dealers have, there's on the order of $5 billion or so of what we can call costs to the shareholders of dealers by being forced to provide collateral for swap positions that where the collateral is not being provided by them, by one counterparty, but they're required to provide it to another. These are called funding value adjustments. This gives us kind of an idea, but this is not a deadweight loss to the system. In some research I'm doing with Leif Anderson and Yang Song, we're showing that this is effectively a transfer from the shareholders of these dealers to creditors and other claimants. By the way, it's not showing up that way in the accounts of the dealer. That's kind of a side story. We're also showing in our paper that these numbers seem to be inappropriately showing up in the accounts of the major dealers as a cost in the valuation of their swap positions. It's not that, and I'm not going to go into that today because it's a different story, but it is kind of an important point that's being missed in a lot of cases. If you go to the next slide, you'll see a highly stylized schematic of a OTC market where we have dealers D1, D2, T3 in the center, and we have their clients, which are not completely connected to each other. They're all connected to dealers. This is sometimes called a core periphery network. It shows up in all of the statistics on any major over-the-counter market. The actual number of dealers in the world is about 14 or 15 major dealers that are handling most wholesale markets that involve collateral. And what we're seeing in this market and have been seeing over the past few years is a very dramatic reduction in collateral required by eliminating unnecessary circles of swap positions among the dealers. So if you imagine in your mind a clockwise circle of exposures of swaps between dealers 1, 2, and 3 that essentially are canceling each other in terms of market risk, but they are leaving open the counterparty risk and require collateral. The dealers have figured out, with the assistance of a firm called Trioptima, that if you merely introduce an artificial but important counterclockwise circle of swap positions called a compression trade, you can crush down the amount of swaps in the system and therefore the amount of collateral required. The total number of these transactions since inception is about 500 trillion with a T. That's 500,000 billion notional of swaps that have simply been eliminated over time. With a current, in the interest rate market alone, the current remaining amount of compressed trades is about 200 trillion. If you go to the next slide, you'll see a CCP in the middle. As I mentioned earlier, that does two things. It adds to the collateral requirements of dealers because now they must post initial margin to the CCP for every swap that they clear, and they do clear most of them. But if they were to be required, as they would be under new regulations, to post initial margin anyway, the data in a paper that I've done recently with Guillaume Vuillet and Martin Scheicher at the European Central Bank shows that the act of central clearing nets down the total amount of swaps dramatically, reducing the amount of collateral correspondingly. On the next slide, you can see what the swap market looks like with and without the effects of central clearing and with and without the effects of compression trades. The highest curve, these are ISDA figures that just came out 3 weeks ago, is what the interest rate swap market alone would look like before considering the effects of central clearing and collateral. It would be, we're getting the effect of financial services in that sector of about 800 trillion notional of interest rate swaps. If you go all the way to the bottom curve, after you take out the effects of compression trades and central clearing, the net effective amount of collateral in the system is that associated with about half that much in OTC derivatives. Now, again, I'm assuming here that the centrally cleared swaps, if they were not cleared, you'd have to post collateral on them anyway. The next slide actually shows the amount of compression trade that's occurring. And I'm not going to go through the last slide, which explains the calculations in my paper with Vuime and Scheiker, but trust me, on the CDS market, which we've analyzed all the bilateral swap positions other than sovereigns and financials, you get a dramatic reduction in the amount of collateral in the system through central clearing if you assume that centrally cleared swaps would need to have collateral whether or not they were cleared. So let me simply close by saying, with the benefit of new repo CCPs, which are coming into play, securities lending CCPs, the use of central clearing, and the use of trade compression, the dealers have figured out how to compensate for dramatic increases of collateral requirements by more efficient use of the plumbing of the financial system. And it's a very natural response, and there's no reason to believe, in answer to a question I think that Manmohan had handled earlier, that these kinds of activities are dangerous or are somehow an end run on the intent of Congress with Dodd-Frank or foreign regulators. These are actually legitimate methods of keeping counterparties safe with collateral, but by doing it with less collateral than you might need if you didn't have all the financial engineering and plumbing that we've been discussing. So I think I'll stop it here. Thanks very much, Doug.
Doug, and thanks to Brookings for inviting me here. The usual caveat works for the federal government, so the comments that I make here are my own and don't represent that of the Commodity Futures Trading Commission. Following Daryl is always a hard act, I guess. So he spoke a lot about portfolio compression, and it just struck me that I always joke in the CFTC that maybe there are 2.5 people in the building who know anything about portfolio compression. The swaps market and the developments that are happening in the swaps markets and the derivatives markets is just fascinating. And the regulations are driving a crazy amount of innovation, especially in the post-trade aspect of the whole sort of transaction business. So one of the issues we have is that one of the things that the G20 mandated and Dodd-Frank and other rules have required us to do is collect data about activity in the swap markets. And interestingly, when the rules were finalized here in the US and I understand in Europe also, we didn't do a good enough job of requiring firms to report compression activity in a very systematic manner. So we have to sort of rely on information put out by Trioptima and LCH. LCH mentioned about a month ago that over a 2-year period, just in the interest rate swap space, they were looking to compress. This is in addition to what Trioptima is doing. LCH is compressing about 235 trillion dollars worth of interest rate swaps. We've spoken to the other CCPs, and there's a huge kind of cottage industry that's evolving, just looking at portfolio compression and figuring out interesting ways of reducing the notional risk that's residing in the books. When I I've sort of gotten to know Manmohan well the past couple of years. Lots of interesting conversations about his book when he was still working on it. And just sitting here listening to the previous speakers, there's all sorts of different issues that are being discussed here. Sort of going through them and doing justice to them over a 2-hour period never makes sense. And we sort of doing some more here. And the SEC, sort of the CFTC is organized a day-long seminar, or this is a roundtable on March 5th. So those of you who are interested are sort of welcome. It's open to the public. Anybody can come. And the issues they're going to be discussing the roundtable are sort of relevant to what others have spoken. The session on variation margin gains haircutting, reestablishing a matched book, the session on winding down of CCPs, and liquidity risk management. So the general approach has been that the G20 mandated clearing and also rules for uncleared swaps. Rules have been finalized. The CFTC directly regulates 3 of the largest clearing houses in the world, LCH, ICE, and CME. And we have rules in place directly regulating the clearing houses. And as Sandy mentioned, and others have mentioned, this is still sort of work in progress. A lot of work is being done. There are lots and lots of different acronyms thrown around, BCBS and IOSCO and FSB. There are a whole spectrum of initiatives looking at all these different aspects of clearing and trying to figure out ways to sort of get us closer to a point wherein we sort of reduce the overall risk in the system. So it's sort of still work in progress. So as an economist sort of looking at this, there's strong interest in sort of data. So maybe it's helpful to sort of, for the audience here to understand what the staffers at CFTC do, I guess. So there are rules in place that mandate what the clearinghouses should be doing. The clearinghouses also have rules. So it's a very rule-driven process, which is good in the sense that it gives you some certainty about what will happen when a default and other situations happen. Where the commission is, the commission also has a set of rules requiring the clearinghouses to directly report to us exposure information, collateral information by clearing member and also customers of clearing members. So we get daily reports from the clearing houses by asset class, basically rates and credit. So there's a wealth of information that's coming into to CFTC. And staff is spending, when we're investing a lot of resources in terms of our ability to analyze the data. And there's actually very hands-on monitoring that happens. Staff will get on the phone with the CCPs, will get on phones with the FCMs, and in some cases, they can also jump on a plane or whatever and go to clearing members' offices if something crazy happens. So it's sort of a very hands-on approach that is being taken. And this is just in the case of the cleared swaps. And with uncleared swaps, and Manmohan was mentioning that one of the later speakers is going to be talking about it, and which is what I'll sort of spend a couple of minutes talking about, is once again G20 mandated that certain set of swaps should be, standardized swaps should be subject to mandatory clearing, and everything else should also be subject to margins. So the regulators, the financial regulators, the banking and regulators in the US, the SEC and the CFTC have proposed rules for margins on uncleared swaps. And so while we know that the dealers have been sort of posting margins and collecting margins, there was a view that it wasn't done in a sort of a systematic manner. So we proposed rules, and we're in the process of finalizing those rules. And interestingly, a lot of time is being spent on collateral. It's amazing to sit in these meetings and see how granular staff are getting into, the granular issues that we're getting into in terms of types of collateral, settlement cycles for collaterals and haircuts, and what types of collaterals. And this is not just in the US, we're also sort of coordinating here with the global authorities and the global regulatory authorities. It's painful, it takes a lot of time, but derivatives markets is a global market. And we have to make sure that we get it right. So it's still sort of work in progress. It's sort of fascinating time to be in the markets, and especially in the regulatory space. There is a lot more work to be done on the cleared space, working on the uncleared. And from my own perspective as an economist, sort of very interested in getting better data. The regulatory reports that we require firms to submit on the uncleared space, we didn't do a good job of getting on sort of defining the information that we need from them on collateral. So that's something that we intend spending some time in the coming years, and is to sort of, while there's a lot of on the cleared space, we get information on collateral. In the uncleared space, we don't get good enough information. So it's important to sort of work with the industry so that we get better information, so that we can monitor the risk in the uncleared space. So that's it from me, and sort of we'll take questions later. Thanks.
Daryl, can you hear us as well?
Yes, I can hear you perfectly, Doug. Thanks.
Well, excellent. Okay, again, thank you all. I thought those were great comments. And Manmohan, I'll give you advance warning. Think a little bit. I'd just be curious when we get to you as to what your thoughts are on what the three panelists said, because I'm sure you have thoughts on those subjects. But in the meantime, let me go through the others. And since Sei was advertising his own event, it occurred to me I should advertise one we're doing on Wednesday if you're not already aware of it. We have Lord Hill, who's the new European Commissioner for Financial Regulation, et cetera. And he'll be here on Wednesday, and he will be talking probably about some of these same issues, though broader than that. But that also sparked a thought, Sandy, for me on what would you like to see in the way of international coordination in this area? Because I know that there are a lot of different bodies involved dealing with even just CCPs. Do you have any suggestions for how that might work better?
Well, that's a loaded question. I do think, if there was something that would be good to see, and I'll keep my comments around CCPs since that was a topic that I was talking about. Clearly, since we're moving the standardized derivatives onto CCPs, what had been typically solely market regulated, it's probably really important that now that these are systemic entities, that there's a combination of both market regulator oversight as well as prudential regulator oversight or systemic regulator oversight. Because again, you come back to the points of during business as usual, you want to keep the markets robust and functioning. But because these are such fundamental parts of infrastructure now, again, they must ensure that if a default actually occurs, they don't cause any market contagion and they certainly don't bring the marketplace to a screeching halt. And that's typically a different look. That's typically a systemic regulator looking again at quality of underlying collateral, protocols for recovery, protocols for resolution. So I would say let's start with firstly getting within jurisdictions prudential and market-based regulators coordinating. And then secondly, there's no such thing as a British derivative or a Japanese derivative. It is a global derivatives market. And as such, the coordination in thinking about minimum standards around acceptable collateral, minimum standards around haircutting, and protocols around default waterfalls, there should be some level of consistency. I think for CCPs, we should ensure that these independent for-profit organizations are hugely valuable, but they should not compete on risk management. They should compete on efficiencies in their operating models, and I do think that level of coordination across global regulators will be important to have the right discussions and crisis management approaches.
Okay, thank you. A question for you, Daryl, actually two questions. First, given all the wondrous things you've described that are being done, do you think there is a shortage of collateral or of high-quality collateral?
No, there's a cost to providing the amount of collateral that regulators have asked for, but supply and demand are going to cross at a price. And I think I've indicated, one set of numbers, the number of billions of dollars that it's costing the dealers to provide that. Some of it is just a transfer payment to creditors. In the swaps market, you don't see a lot of frictional cost to the system because almost all of the collateral in the swaps market is cash. But you are seeing it in some of the examples that Manmohan went into, where there's rehypothecation of securities that are trapped or not trapped, various kinds of slowdowns. That is a real cost to the system, and it's a trade-off, and I think we got to keep working on those efficiencies.
Okay, and then my second question for you is, you've indicated that you're broadly comfortable with the compression trades and the similar benefits that you get from using the CCPs. If you're wrong, how would you be wrong?
Well, let me focus on Sandy's remarks. And by the way, I've asked Sandy to come to the Chicago Fed on April 10th and elaborate on what she spoke of here, because it's very important. If we're wrong about doing central clearing because regulators don't get together on minimum safety standards and coordinate so that we don't get a race to the bottom, then we'll be plowing a lot of risk into new special purpose financial institutions that, if God forbid they ever were to come apart, would cause a very serious problem. This is kind of like preventing a nuclear accident. You don't design a nuclear power plant so that it only fails with a 1% probability. You do your darn best to make sure it doesn't fail. And we need to do that in the central clearing space, or this whole G20 effort will go wrong someday. How many years, how many decades, I don't know. We just need to avoid that, and there's plenty of time to do it right, to get the financial engineering right and the regulations right. So I'm pretty optimistic that it will get done right, and I think the cost benefit justifies the effort. But if there was something to have gone wrong, if we don't do it right, that's where it would show up in the part of the financial plumbing that requires collateral.
And do you see any similar type of risk with the compression trades, or is that just a very straightforward thing from your point of view?
There's a little bit of financial engineering where there's some risk management that's not absolutely crushing the swaps, but the vast majority of it is literally just eliminating effective swap positions, just lowering unnecessary redundant swaps. I've looked at it pretty carefully. It's very, very good stuff.
Okay, thank you. Then say, from the position of working in an agency where you're trying to get the best thinking and help to formulate the best rules, what would you like to see academics and others looking at? I mean, what kind of research do you need to be done that's not being done so far?
It's a good question. So the issue with academic research is that a lot of so there are two types of research. There is theoretical work that gets done, theoretical modeling, and then empirical research. To my reading, a lot of theoretical and empirical work in the context of sort of systemic type risk issues has been done in the context of banking, right? And it's only now, in the past few years, that you have sort of seen people venture into CCP issues. And even there, barring a few exceptions, a lot of academicians might not understand sort of the institutional framework of CCPs and sort of and various sort of intricacies and idiosyncrasies of CCPs, I guess. So there are some papers I see where they just get the details wrong. And even there, a lot of the work is just, initially was theoretical modeling, and because people didn't get access to data. Daryl was mentioning some of the work in the context that's been done in the context of CDS, because there's a market for which data has been available. What the data that folks haven't had access to is on the rate side, which sort of sits with the CCPs and it sits with folks like us. So Daryl and I have had a lot of conversations, and also we're talking to other folks, encouraging folks to sort of come to us and with ideas on, we have the data and we sort of interested in folks getting access to it to do research. So once again, a lot of the work has been done in the context of banking, but there's a lot more work that can be done in the context of CCPs also.
Maybe a loaded question, but do you have any sense of how long it'll be before we have an equivalent level of understanding of CCPs, collateral, et cetera?
It's full employment guarantee for economists. So this is a very dynamic marketplace, and the markets are, so while the interesting thing is, while there is a new regulatory framework in place, there is strong interest among all the regulators to ensure that we really don't kill the market, that we want to encourage innovation. And so the rule making, though, so at some level you said, G20 mandated clearing, right? But when we've gone about finalizing the rules, it's been a very consultative process. So what's going to happen is that the markets will keep evolving, right? Driven by what the markets want. And new sources of risk will come up, and new issues will come up, new products will come up, which people want to submit to clearing. So this, it's still early days, clearly, but even in the case of banking, there are issues that we're still trying to figure out, I guess. So
that is certainly true.
Yeah.
Okay, Manmohan, now that I've given you advance warning, what comments do you have based on what the others have said?
I think I'll combine the general point which Daryl and Sandy have made. We need to get this design process of CCP correct. It's very fragmented across jurisdictions. For example, you will find Europeans, and we'll learn more in time about the haircutting on how to save CCP, etc., the recovery resolution. There is a serious gap of understanding. In fact, in some jurisdictions, they are happy to have CCP get more business. So there's a business hat, and there is, a business hat which, say, a UK would like to wear so that it doesn't lose the inertia of its LCH being sort of the monopoly on rate swaps. And there's also another hat which the Europeans would like to wear to get some of the business, because they'll get into issue if something went wrong, will Bank of England have the euros to support? There are many game theoretic events you can think about, something happening in Europe, etc. But the bottom line is there are still large gaps, and VMGH is one issue where a UK CCP has limited VMGH cuts. And if you really don't like that, say a Dutch pension fund, you can go to Eurex or you can go to continental Europe where they don't have that. They would actually like to have some business. So between the business hat, which is worn by all four private CCPs, LCH, CME, ICE, Eurex are all private CCPs. And ironically, they are also having niche markets which they would like to keep a handle on. It's a niche market business. Else, if all CCPs were in sync, we would have concepts like interoperability, more netting, etc., etc. So it's very ironic that the major 4-5 CCPs kind of like to do the things their own way to get businesses. And over there, the regulatory effort of synchronizing it is being lost. And I think it can become dangerous. As Professor Duffy mentioned, if we get this wrong, if a CCP blows off, Lehman would be minuscule. These are three big to fail, not too big to fail. And one
Surprised you're not up to 4 big to fail by now.
we'll, we'll see. But I think this one technical point I mentioned, because there are some people on the central banking side that yes, collateral will, any shortage can, there's a price, demand, supply, and at a price you can always find something. However, I don't want to miss out on the fact that if, let's say in this part of the world, US, if 3 trillion of siloed treasuries and MBS since Lehman, that's HQLA, what we call in regulation, high quality liquid collateral. There's also reserves, which has been come out, called HQLA, but both are very different. And this is the point which I try to make from a financial lubrication angle. What we have taken away and what we have replaced, both qualifies as HQLA, both are equal credit, but in terms of the lubrication, one was more familiar in the bank, non-bank nexus, while the other remains only in bank. So there's a serious difference in the lubrication of the financial system, where we replace one HQLA with another, and yet there is a subtle difference which gets lost in most of this regulatory debate. They say we have given you an HQLA, and I personally believe some of the work that HQLA qualifies in all terms, but as a lubricant is different than what you have siloed.
Okay, thank you. So let's give the audience a chance again to ask some questions. Same ground rules as before. Okay, sorry, further in the back there, yeah. Yeah, about there.
Hi, I'm Rena Miller with Congressional Research Service. So I have 2 questions. One is, I think, a little simpler, but a lot of people talk about the cataclysmic possibility of a CCP having a problem or failing. Just to clarify, do you, Professor Duffy and others, are you referring pretty much to operational risk, whether it's a cybersecurity event or just a software glitch or the trade compression, algorithm being wrong? And my second question, I think, is a little more complicated. It's there's been a lot of anecdotal sort of talk about OTC derivatives trades moving overseas to affiliates that have implied guarantees but aren't explicitly guaranteed. And I'm just wondering, how prevalent is that practice, and how is that impacting the need to post collateral? If it's extremely widespread, then maybe it's, leaving a lot of things unchanged. So those are my questions.
Okay,
Okay.
Daryl, you were mentioned. Why don't you start? But then anyone else can jump in.
I'll start that one. Your question is very perceptive. There is the opportunity for an operational risk. CCPs for swaps are not quite as short a time fuse as a CCP for, say, a securities settlement or repo, where you need overnight at latest performance. In the case of a swap CCP, these instruments are very long term, 3, 4, 5, 10, 30 years. So if you were to have a several hour outage, while it might cause conniption fits, it's not going to bring the system down. The kinds of risks that I believe that we've all been speaking about for the last few minutes are where one or more of the clearing members is unable to meet its obligations in terms of payments to the CCP. And when the CCP tries to unwind the swaps of that failed clearing member or members, it doesn't have enough resources to do that. So there's been a lot of discussion about how much initial margin is necessary. Sandy mentioned how much is appropriate in terms of the default guarantee fund contributions of the banks, and when you should stop drawing on that because you don't want to bring them down too. And there's an important additional issue which is called skin in the game, meaning how much capital should be thrown in by the operator of the CCP. So that entire waterfall of default management resources needs to be very robust. It shouldn't be, as I mentioned earlier, designed to fail once a decade. It should just be enough. The second part of your question was, what if it isn't? Is there some sort of guarantee coming from other authorities? First of all, the central banks of the world don't do that. They only take liquidity. They only provide liquidity to the CCPs. They don't provide capital. If, God forbid, with everything that we've discussed in terms of the waterfall plus the central bank liquidity, there was still a shortfall, it actually happened in Hong Kong in 1987. the government and the banks ended up sharing the cost of restarting that CCP. And nobody wants to say they would do it, but I think implicit in Sandy's remarks is you've got to have it. It's required by regulation that we restart these CCPs. You need a pool of capital to do it. Actually, J.P. Morgan made a proposal on how to do that. The other panelists may have different views about where that capital comes from, but somebody has to suffer the losses, and somebody has to recapitalize the CCPs.
Yeah, I would think just to add on, and thanks for the mention of the paper, Daryl. It's available actually in the back for those of you who might be interested in reading it. You know, again, you know, particularly in the United States, it's very, very important that if there is a cataclysmic event, and I agree completely with Daryl, we're not talking about the operational risk. Let's put that to the side. We're talking about default members fail and the resources that are available through initial margin and guarantee fund are inadequate to cover the losses that have been taken. Then in fact, as you look through to how to keep the operating entity open for business, remember these CCPs are no longer user-owned. So in that context, the recapitalization is not going to be coming from private sector or clearing members into a for-profit run failed institution. And that's what we talk about, the recapitalization for resolution. So if there are not adequate resources, the CCP actually is closed in its existing management form, but the pipes remain open for business. And what the paper talks about is a capitalization that exists right now in an escrowed fund that is available to restart that CCP because the organization, the industry cannot bear a complete unwind of something that's so critical to systemic infrastructure. So it's interesting because will that cost more? Yeah, it will cost more. But again, the obligation for systemically important CCP should be no different than that for a systemically important financial institution. On the day of demise, it cannot disrupt the financial markets. And goes back to my earlier comments. Therefore, it can't be a switch off and liquidate. It has to stay open. In what construct can it stay open? You can only stay open for business and financial services if you have adequate capital and adequate liquidity. And therefore, it has to be pre-funded and prepared for today. Now, the question is, there's lots of talk about what's the size, who should be the major contributors, but that is what that paper discusses. With regard to skin in the game, it has two components. CCPs in and of themselves are reasonably thinly capitalized, right? Because a lot of that shock absorber cushion that Manmohan was referring to is really initial margin as well as the default fund. That is the equivalent of capital, right? Now, one talks about very frequently in the default waterfall, how do you align interests? And there's a lot of discussion in the industry is, are the CCP's interests of growing revenues, adding new products, bringing on new clearing members, really aligned to the underlying clearing members who actually bear the risk if it all goes wrong? And therefore, it probably makes some level of sense to have a higher level of skin in the game for CCPs, because by the way, it's inconsistent across CCPs. And secondly, you know, once you have the skin in the game, do you also have a protocol for governance so that clearing members who, again, bear the end risk of it going wrong have a say in the risks as it's being brought onto the CCP? That's really super important. Alignment of risks really matters here, and I think that's where we have some work to do.
Okay. Either of you have a burning desire to answer this, or shall we move to another question?
Next one.
Go for another question then. Up front here.
So this is a question about, it's a macroprudential question. We're seeing the evolution of a system in which we have banks connected to markets, derivatives, money market, capital market. And what we're trying to do now is understand the system. Obviously, the system existed as of 2007 when we discovered how we were not looking at certain aspects of it. So we have the central bank, which is a provider of liquidity for last resort. The question is, in this new system, do we need a market maker of last resort before we say hit a systemic wall? So does the role of a central bank in some sense now become more expanded, or we need another organization to be a market maker of last resort in this sort of newly evolving system? By the way, I'm Sunil Sharma. I work for the IMF.
Okay, thank you. Well, that's a nice, easy question. Would one of you like to take it?
Well, I'll take a shot at it.
Go ahead, Daryl. Go on, Daryl.
Central banks of the world will never say that they will step in as a market maker of last resort. But they know since the time of Bagehot that when the event happens, that the system will be better if they do. When that happened in the last financial crisis, some central banks, particularly the one in this country, took a hit from Congress or from the legislatures over the degree to which they did act as a market maker of last resort. That inhibited the independence of the Fed. And I personally, and in fact we've spoken at this, Doug and I have at the Brookings institution before, hope that the Fed will again be given enough discretion to become a market maker of last resort if, God forbid, it's necessary. However, having said that, in no way should the central bank say explicitly that it will do that and under what circumstances, because the moral hazard implicit in that is very severe. So I think the central banks are doing the right thing by not offering to serve in that role, except as indicated in their normal policies, where they're already doing that for certain types of securities and in certain circumstances with a very limited set of counterparties, namely the banks.
And I would just add, look, the first line of defense in the default waterfalls are actually the clearing members who are going to be auctioning off the securities. And to bring it around to where it all started at the very beginning, what collateral we're talking about will have a fundamental impact. And I think with regard to these CCPs, a probably more stringent lens around what will be acceptable collateral should occur. And just to give you some frame of reference, presently, depending on which CCP you're talking about, it can range from US Treasuries to physical gold to corporate bonds. All of those behave extremely differently in stressed markets. Some are right-way assets and some are wrong-way assets. Some will maintain market depth, some won't maintain market depth. And a haircut, while it can adjust for a lot of price volatility, can't necessarily adjust for liquidity. So again, it goes back to the first line of defense are those clearing members who are going to be auctioning off those securities. If that auction fails, I agree with you, Daryl. It's very likely that central banks will need to step in, but it should only be to provide liquidity against good assets. It shouldn't be Absolutely. To subsidize losses of capital. And I think particularly in this country, which is quite different than in other areas of the world, that is really important. We could not put forth, as an industry or an infrastructure framework, anything that would be reliant on a bailout. That's just not acceptable. Hence the ideas for pre-funding any potential assessments and pre-funding a recapitalization fund.
Comments?
So just sort of an insider view, I guess. So we have a division of clearing and risk, which spends a lot of time with oversight of the CCPs. And you talk to them and they'll say, it's like, yes, we have all the default fund process and all the waterfalls, but they define their job as ensuring that we never ever have to rely on those things. And just sort of linking that to some of the comments being made here over the role of the central bank, where we are today is because of the regulations and because the CCPs are considered as systemically important. The Board of Governors of the Fed and us, we have joint oversight over the CCPs. And we spend a lot of time talking to our colleagues at the Fed and working with them on very, very specific, highly technical issues related to all aspects of CCPs. So the Fed is already involved in the process, and the market regulator and the prudential regulator sort of working closely with them, and not just in the US, even in Europe. So there is a lot of work that's already being done very collaboratively between the market regulator and the prudential regulators.
And how different are the views from the two sides on a typical issue?
There's a joke, you get two human beings, there are three political parties. So no, there is, and I think it's very healthy. And Manmohan, and I was sort of chatting with him earlier saying that as a market regulator, my background is market microstructures. As a market regulator, you have an objective function. As a banking regulator, you have a different objective function, and that's a fact of life. But what I see is that it's all good coming out of it. It's very painful when you sort of see when we start off the debate, I guess. But at the end of it, I think there is shared interest. The common interest, the goals are the same. And once again, as Daryl was saying, like central banks don't want to be the market maker of last resort. They want to ensure that we never get to that point. And as a market regulator, we have sort of, while we're not in a place to be the market maker of last resort, but we don't want the default processes and everything else. Market integrity and the continuation of the markets, the fact that the CCP should always be in operation, can't shut down, is core to us. Because for us, a CCP not opening the next day for business is catastrophic, because what happens to the markets, what happens to trading? And the CCPs that we're talking about are not just doing swaps, they're clearing futures also. And if you go to Europe, they're also clearing on the cash market side. So everything is linked. So there's zero tolerance in some sense. So it doesn't really matter that we have different objective functions. We sort of work our way
But again, just going back to, I think we're going in the right direction. But presently, CCPs, for example, they bring the risks onto the CCP itself. They own the risk management decision, and they don't have the skin in the game, nor the scalable skin in the game that occurs as they bring on new products, for example. So I think getting to the right thresholds of what's appropriate to be cleared in a standardized way is going to be absolutely critical, because again, as a member of CCPs and sitting on risk committees, you sit on risk committees and you have a fiduciary seat, which is you think about risks in terms of your fiduciary responsibility to the CCP. There's not a framework or a forum where there's a formal risk appetite assessment of, yes, we think this is an appropriate new product to come on, or this is an appropriate piece of collateral that should be accepted. And given that clearing members, as I've said a few times, end up owning that risk, that has to be formalized. It has to be formalized on global CCPs, because until that really occurs, someone else is making the put risk on decision, and someone else owns the risk off result. And those two things need to be aligned to be effective.
Okay, we've run out of time. So we're going to do this little drawing to see which three of you have won a book. I'm not exactly sure why we're doing this, but since we're willing to give it away, let's see. All right. First one is, the name's on Alessandro Scipione. Okay, and Cleopatra Nicolau. I'm sorry, I probably got that wrong. And then, let's see, Rena Miller from the Congressional Research Service. It was a very good question. So thank you all, and thanks everyone. Thank you, Daryl.
Thank you.